Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms. We've got such amazing listeners, and every day you're sending us questions, and when we can, we like to provide answers. Today's show is called Ask the Guys. Lots of great questions, including some very timely ones today on the Real Estate Guys radio program.
With everything going on in the world, don't let your lack of financial understanding derail your investments. Real estate investors need to see the bigger economic picture. The Federal Reserve, bonds and interest rates, precious metals, oil and gas, cryptocurrency, and the inner workings of monetary policy, just to start. If you're at all confused about how and why market metrics intersect and what it means to you as a real estate investor, take your understanding to a new level with the Future of Money and Wealth video collection. Discover the opportunity to hedge against inflation, deflation, and stagflation. Gain critical insights on real estate niches that perform well in challenging times, and learn specific strategies to fortify your balance sheet before it's too late. Simply send an email to future@realestateguysradio.com for all the details. The Future of Money and Wealth includes 20 videos of powerful presentations and panel discussions featuring Robert Kiyosaki, Peter Schiff, G. Edward Griffin, Dr. Doug Duncan, Simon Black, CPA Tom Wheelwright, Brian London, Dr. Chris Martinson, and many more. Email future@realestateguysradio.com today.
Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms. With me, as usual, it's our co-host, financial strategist, Russell Gray.
Hey, Robert.
Every few weeks, we love to dip into the email bag and find out what the listeners are thinking about. And last week on this show was Clues in the News, and we gave a shout out, hey, if you have any questions, in light of what's happening, send those in. We've got a bunch of Ask the Guys questions today. Some are more timeless, but some are very timely. And here's how Ask the Guys work. You go to the website at realestateguysradio.com, click the button that says Ask the Guys, and then fire away. Tell us your question. We've got several questions today, and our only disclaimer is that we are not tax or legal professionals, and we don't give advice. We give ideas and information. So with that, here we go. First question is from Suzanne in Sonora, California. Hey guys, I'm 56 years old. I have a duplex valued around $270,000 with $210,000 of equity. I've read Rich Dad, Poor Dad, and I've used equity lines in the past to buy other properties, but I'm at a knowledge impasse. It has to do with mortgage payments. If I take out more equity lines to buy more properties, eventually all my profits are spent on making loan payments. Help, I think I'm doing something wrong. All right, Suzanne. Well, really, you're not doing anything wrong. There's kind of this premise that a mortgage is a tool. It's a great tool, but like any tool, it has to be used for the right job, and it has to be used correctly. A chainsaw is a great tool for certain things. If you're trying to get a splinter out of your hand, it's not a great tool. Or if you're trying to chop down a tree, but you haven't been educated about it, it's not a great tool. And mortgages are an awesome tool. In fact, our first three questions today have to do with mortgages, so I think it's time we call on our financial strategist.
Well, I think this is a great question and one that everybody should really be thinking about. Robert, I love your analogy of the tools because you do have to be very cautious. The obvious risk here is that you take equity out of a property and then you finance it using short-term financing, in some cases callable financing, or even adjustable rate financing, and then you go make a long-term investment. So one basic rule of thumb is don't borrow short to invest or lend long. Unless you're a bank and you're backed by the FDIC, you can end up on the wrong end of a cash flow problem that way. So that's number one. Number two is when you're playing that game at the top of a market, when the cap rates are very low, in other words, the cash flows on new properties are very low, the danger that you run is that you get a downturn in the economy like we're experiencing right now, rents go down, and now you've got negative cash flow on these properties, and worse, you end up with negative equity. And that happened to a lot of people, including me, in 2008 because I wasn't attentive to the very thing that I'm going to talk about just now. So the idea is that when you pull the equity out, which I think is a smart thing to do, you want to lock in long-term permanent financing. That's number one. There's no reason not to do that in today's environment. Today's rates are excellent. Might they go lower? Yes. Will they go lower enough that it would be dumb to lock in long-term rates? I don't think so, because they can't go too much further down. So I think you're very safe making a long-term commitment as long as you're interested in being in the property long-term. Now you've got the equity. The real secret in doing this is what we call arbitrage. It is purchasing a reliable stream of cash flow that will take care of making the payments and providing you a positive net result. If all of your payments are being used to only make equity payments, then you're not making a smart investment with the equity you extracted. If you borrow at 4% and invest at 4%, you're break even and you're betting solely on the appreciation of the property and the tax breaks. That's probably not a good move. If you can borrow at 4 and you can cash flow at 8, that's a much better move. So sometimes you actually want to not purchase income properties, but you want to purchase debt loans. And you can purchase those loans, private money loans, and make them directly on a piece of collateral, a property you would be happy to own, where the borrowers put in 30 or 40% down. That's your protective equity. And if you were to foreclose, you would end up purchasing the property in effect for your loan balance, that what they owed you, which would be a 30 to 40% discount. So that you definitely want to take advantage of the equity you have. You can definitely use it to purchase additional properties. And I could go deeper into strategies on that, but for the sake of today's discussion, I won't. But the real key is to make sure that you borrow long and invest short or shorter than the length, and make sure that you're very focused on the quality and the durability of the income and the recourse if your income that you invested for goes bad. And you need to be much more attentive to that in today's market. But still, if you have access to equity and you have access to inexpensive loans, I would definitely be tapping into that, because a pullback in the economy and real estate prices is going to take the equity anyway. You might as well get it.
Yeah, that's a huge point. If you're sitting on equity right now and we feel good, we sleep at night, we're peaceful when we have a bunch of equity in a property, but we're also a target. We're a target of lawsuits. We're a target of the powers that be. We're a target of the downward part of the market that Russ is alluding to. If all of a sudden prices go down and your equity disappears, wouldn't you rather have grabbed it and now you're in control of it? And it really comes down, Suzanne, to just doing the math, and the math will tell you what to do. You would never want to borrow from a property and have a situation where you're buying another property and the payments are eating up all of the profit. You just wouldn't do that. If that were the numbers and you ran the spreadsheets and said, hey, if I borrow over here and I buy this other property, then all my money's going towards the mortgage payment, then that's probably a non-starter. That's probably not the thing to do. There are times when you might think that way, but right now where we're headed, I wouldn't take that risk. So good job. Accessing equity can make a ton of sense for a ton of reasons right now. The next couple questions, also somewhat related. This one comes from Paul in Kaysville, Utah. He says, guys, when and how do you decide whether to take equity out of a single family home or refinance with longer terms for more monthly cash flow, or to decrease cash flow for a shorter payoff? Okay, this is great stuff. He's got some specifics. We have several properties with equity of over $200,000 each, currently at 4.5% interest. If we refinanced at current rates, it would increase the cash flow by $60 each month and put the terms to 30 years. If we shorten the terms to 15-year, it would reduce cash flow by $400 a month. If we take $50K out, the cash flow would be $200 less and the loan would be back to 30 years. We're looking to retire in the next few years and also to buy more properties. This county has been strong for several years and is a desirable area with military, manufacturing, service, IT, etc. Rents have moved up in the recent couple of years and demand for homes and rental is moderate to high at this time. Thank you. All right. Well, first of all, that's great that there's a good variety and veracity of tenant base. But of course, when many governors are coming out and saying there will not be any foreclosures, there will not be any unlawful detainers, you can't get tenants who don't pay out of your properties. You just have to think about that stuff. So we won't dwell on that. You got to know what is happening there. But this is one of the age-old dilemmas. And I'm going to start by saying, remember this. It's something so many people forget. Refinancing is an awesome tool. When rates go down, it can make sense. Because of what's happening in your life, changing the terms, the length of the loan can make sense. But here's the big but. Every time you refinance, you start the clock over. At the beginning of a loan, you're paying mostly interest and a tiny bit of principal. Every payment you make, there's more and more principal being paid down, meaning you own more and more of the property. If all you do is refinance every few years, you start that clock over again every time.
Yeah, if anybody has never done this, you should do this. Just open up Excel, click on a loan amortization template, and start playing around with the numbers so you really understand what it's like and how much of your payment every month goes to pay the interest. If it's rental properties, it's not bad because it's coming from the tenant, and there's some deductions that you get that improve your cash flow as well. But let me just get into the specifics of this. One of the questions was, do we use a shorter term loan, a higher amortization loan? First of all, the only reason you would use a 15-year loan over a 30-year loan is to get a lower interest rate. That would be the only reason, because you can accelerate a 30-year loan on your own.
Yeah.
So if you want to be on a 15-year payoff, you can still have a 30-year loan, and you just add additional payments to the principal, going back in that Excel calculator I talked about, and you can determine. The thing is, it puts you at a requirement to make a lower payment. So you don't need to make the payment. It gives you some cash flow flexibility. So you can control the amortization. The bigger question is, do you want to amortize a property? My answer is always no. I mean, I always want to pull the equity out. I would much rather pull equity out, as we discussed in the previous question, even if you're just parking it in something like precious metals. I did a whole presentation on this during the Future of Money and Wealth, and people that did that extracted equity and used the arbitrage with the private notes that I discussed, and then used the difference to invest in gold. You're basically just converting your equity in your property to equity in gold, which is outside the banking system and completely outside the dollar. And that's a way to do it. It isn't about making money on gold. It's about protecting your equity and separating it from the liability of the property and the whims of the real estate market, which, as we know from 2008 and probably now going into 2020, the early 2020s, equity comes and equity goes. What you really want to focus on is cash flow. So the idea here is that if you're going to refinance, it's the same rule: pull the money out and then use it to reinvest in additional streams of cash flow that will easily make the payment, give you a degree of comfort, and make you a profit. If you own something that has a good chance of going up in value, or you apply additional financing where you're going to get additional leverage and then can pay down, that's great too. But again, depending on when you submitted this question and what's going on in the market as we're recording this, I would say that you want to be very, very careful about what you choose to invest in the current market, because we just don't know how difficult this economic recession is going to be as a result of the coronavirus.
Absolutely. Great stuff. And again, do the math. The math will tell you what to do. A lot to think about there. And hopefully we've given you some ideas to work through it. We're not trying to give you the answer. That's not our job. Our job is to make you aware of the variables and how to think about coming at the answer. That is teaching a man to fish instead of giving a man a fish. Question 3 is also a financial question. It's a good one. This comes from Fletch in Houston, Texas. Dear real estate guys, would you please share your perspective on how to best strategize the cash out refinance in a multifamily investment? Thanks, Fletch. All right, so the same thing, same idea. You've got a piece of property secured by a loan. In this case, it's multifamily. Now, here's the big difference. If it's 5 units or more, that's a commercial loan. Typically, there's some big differences in commercial loans, one of which is in the commercial world, you can't just refinance every time the rates drop, because commercial lenders commit to putting a big chunk of money out for a specific amount of time. If you pay it back early, there's something called a defeasance clause, or it could be called a number of things, which is basically a prepayment penalty so that the lender can earn the interest they would have earned if you had kept the loan in place. So it doesn't mean that you don't refinance multifamily, but it means you typically do when the loan is ready to come due. If it's a 5-year loan at the end of 5 years, or 10 years, if it's a 10-year loan. So if that happens, can you take cash out of a multi-unit property? Absolutely. And I think the question, Russ, is, what do you do with that cash?
Yeah, well, there's two things. One is, with all of these, you want to be working with your mortgage professional, whether it's somebody who specializes in 1 to 4 residential or somebody that specializes in commercial multifamily. And you want to be orchestrating the preparation of your documentation to be sure that you're going to qualify for the best possible loan by presenting the best possible package. And sometimes that takes some time. There's things you can do in managing the property and organizing your finances, even your personal balance sheet, to be very attractive to a prospective lender, and you get their best possible program, their best possible rate. Once you have access to the equity, as we've discussed in the previous 2 questions, I think you want to take it, because if you don't, the market might. The key is what you choose to do with it when you get it out should be a combination of preservation of equity, preservation of wealth, cash flow to make sure that you have positive arbitrage on the cost of the borrow, and then long-term equity growth. meaning additional properties or other things that you think have the potential to go up. I think that in all these cases, if you're fortunate enough to be in a situation where you have equity and access to inexpensive mortgages, you should take them, because the probability, again, is that values are going to fall over the next year or two, depending on how long this economic crisis that we're in lasts and how it rolls out. And when that happens, the people who are liquid are going to have a real opportunity. So you might even be willing, if you can afford it, to suffer a little bit of negative or barely positive cash flow in the short term to retain a high level of liquidity, so that when the bargains are in the marketplace, you will more than make up for what you lost during the hold period of time where you were basically sitting on cash or some type of a cash equivalent. And then you're going to step into the marketplace and buy at the best possible price. And then over the course of the next 5 or 10 years, your internal rate of return on that investment will more than make up probably for whatever you lost for the short period of time you were sitting liquid. So that's something that everybody sitting on equity should be thinking about right now. My opinion.
I could not agree more. I think there's one other paradigm we need to talk about, and that's just in general what we call return on equity. So imagine you bought a property like Suzanne's example. She's got all this equity, which means that what her return is, not based on her purchase price, but based on the equity she has now, has gone down. Part of the reason we like cash out refis is it lets us raise that return on equity because we have less money in the property. We're starting to play on the house's money. The ultimate extension of this, we talked about on last year's summit, the idea of infinite returns. When you've gotten all your money off the table, you're only on the house's money, you're only on lended dollars. Now that's an infinite return. So when you're thinking about strategically, do I take money out? And if I do, what do I do with it? You just have to think about this whole idea of not just return on cash, but return on equity. It's Ask the Guys. We've got lots more great questions coming up today on the Real Estate Guys radio program.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Do you have a self-directed IRA invested in a syndication? Guess what? It's a ticking time bomb. Why? Because IRAs get hit with UBIT taxes, even Roth IRAs. Hi, I'm Damian Lupo, and we fix this problem for you forever. It gets even better because using the EQRP, you can literally get rid of taxes from all of your gains forever and protect your nest egg. The EQRP is the best vehicle to get it done. IRAs can't do it, not even Roth IRAs. You see, UBIT happens whenever any type of IRA invests in anything with debt. Don't worry, even if your IRA is already invested in a deal, we can kill that tax. Our team at Total Control Financial is here to give you control of your retirement money and free you from that deadly IRA tax forever. Want to learn more about the EQRP? Send an email to eqrp@realestateguysradio.com. I'll email you my special report and send you a copy of the QRP book. Paying a 37% UBIT tax is stupid. First step to getting rid of that tax is to send an email to eqrp@realestateguysradio.com today.
Having trouble finding deals where the numbers make sense? Invest in an asset class that delivers cash flow to you in good times and bad, and where most of that cash flow is tax-free. I'm Dave Zook. Many of you have heard me speak at Real Estate Guys events or heard me on their podcast. My team is a top 5 ATM operator in the country, and right now accredited investors can make cash flow returns well into the double digits and get huge tax deductions. For your free report on this lucrative asset class, email atm@realestateguysradio.com.
Hello, everybody. David Stockman. I'm the author of the Contra Corner blog, and you're listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio show. Thanks for listening to the program, whether you're doing that on the radio or on the podcast or in some other weird way. We're glad you're here. It's Ask the Guys. Your questions, our answers. If you have a question for the Real Estate Guys, just go to our website at realestateguysradio.com and click the button up in the upper right that says Ask the Guys. This question comes from John in Fargo, North Dakota. Hey guys, long-time listener, first-time caller. Well, emailer anyway. Love the show. You guys have inspired me over the years and continue to provide outstanding content to us, your listeners. Just an aside, when you start your question with a really nice comment, there's a much greater likelihood we might get to it. Okay, thanks for all you do. You're quite welcome. Wondering if you've had the opportunity to invest in syndicated deals in the upper Midwest, North Dakota, South Dakota, Minnesota, of new construction multifamily or new construction industrial warehouses? Which might you lean towards? Thanks again for all you do. You guys are the best. All right, John. Well, obviously, we're not going to give you advice on what to do, but it's a fair question. It's always, investing comes down to compared to what? If I was looking at a couple of syndications and one was new construction multifamily, a bread and butter product where there's great loans available and an absolute need that very rarely goes away, or new construction for industrial warehouses, places that store stuff, here's what I'd be looking at. First of all, the market is going to matter a ton. So what is the current supply? What's the current demand? What trends are happening that are going to influence those things? Let me give a couple examples. If a trend is loans are more available at lower prices, then that means that people that were multifamily tenants might be buyers. We've seen that happen in our career. On the other hand, if you see that certain businesses are withering and certain businesses are thriving under, say, coronavirus, would that mean there be more or less demand for warehouses? Well, that's a big it depends. If, the big companies that are shipping and having logistical challenges right now and hiring people are your tenants, that could be an outstanding place to be. On the other hand, if they're quote unquote non-essential businesses, then maybe not. So there's a ton here. I think I'll just give you my opinion. All things being equal, some of the safest investing is in housing because people need a roof over their head. And because the government, as we've seen time and time again, will take care of voters. Now, that's not to say I wouldn't be interested in industrial warehouses. They have a much lower cost to build. The returns can be great. You can have longer leases. So I like both. But that's the kind of way I'd approach the question.
I think, we always talk about this, and I'm a big believer in having patterns and principles to help guide you through decisions. And our pattern and our principles for making investments is pretty straightforward. You start at the top with your personal investment philosophy, and you have to ask yourself, what is it that I want my money to do for me? And it's a big question, and we won't delve into all the components of it, but either you're interested in cash flow, you're interested in equity growth, you're interested in preservation of wealth. There could be some other things that you're interested in, conscious capitalism, something that you feel like you want to be a part of. So there are considerations that you have. Obviously, investing in a syndication, presuming as a passive, meaning that somebody else is running it, that is a personal investment philosophy decision versus you running the project. So that's all part of the philosophy. Once you have that, the next thing you do is you look for a market and markets. And it's not just a geographic market. In this case, we're talking both a geographic market, upper Midwest, North Dakota, South Dakota, Minnesota, and we're talking about a product niche or market, meaning multifamily or industrial warehouse. Beyond that, the market is the demographic that it serves. The tenant base that's going to be in the multifamily or the industries that are going to be served, the customers who would be leasing out the industrial warehouse space. Obviously, it's pretty well known right now. Amazon is on a big hiring spree because everybody's sheltering in place. Anything having to do with logistics and shipping and online ordering is just booming, just like online conferencing is. So those are markets. So demographics, geographics, and then the product niches are part of it. Then this is the biggie. You drill down into the micro geographics or the local geographics, but you also get into the team. The team is the biggie. Now, I'm going to pick a team that I feel has the best chance to execute, the one who really knows the market. I need to be strategic in my thinking, but the people who are actually putting the project together and running the project have to be really up on what they're doing. They have to know how they're going to market, how they're going to get tenants, how they're going to manage, how they're going to compete for maybe a shrinking pool of cash flows that are out there. How are they going to operate and hit their numbers? And if I have a lot of faith in the team, I might take a lesser market or a niche that I don't believe in as much, believing that that team is going to win. The old adage, a coach can be so good, he can take his players and beat you, or he can take your players and beat you because he's just the better coach. Doesn't matter. He can take lesser players and still win. So the team is really important. And then ultimately you look at the deal and you have to ask yourself, does this deal make sense? But I think that's probably the less important thing of the other three. Get the other three right, and then you'll know what to do for yourself.
All right. Thanks, John. Next question, also about syndications from Graham in Charlotte, North Carolina. Do you guys have any syndications you can recommend? I'm familiar with a few companies that offer this type of investment, but would like other options to research. Thanks. Well, basically a syndication, in case you're not up to speed with that, is a passive investment. You're not the one actively in the marketplace dealing with the brokers and the mortgage professionals. You're not the one signing on the line. You don't manage the property. You don't construct the property. What you do is you passively invest. And so this can be a really great tool for folks that love real estate, want exposure to different markets and different product types, but don't have the time or the inclination to be doing the work. So there are several companies ranging from, small outfits to big institutional companies that provide these kinds of opportunities. We don't really point to anybody directly, but we do have kind of a cool service called Investor Registry that we don't talk about very often. When we go out to events, we speak at other people's events and there's trade shows and we have booths. The real estate guys really don't have anything to sell folks other than, hey, we've got seminars and education and listen to our show. But a few years ago, we recognized that we get a ton of deal flow. Lots of deals come across our desk, more than we could possibly do. And that gave us this concept of what if we could figure out a way to get some really good deals into the hands of folks who listen to the show without us being principals or stepping on the deal or any of that kind of stuff. So it's called Investor Registry, and you can get signed up for that service right now for free.
Yeah, it's basically kind of born out of the idea of a bridal registry. When you go in and you're going to have a party and your guests are going to bring you something you'd like to have, you tell them ahead of time what you're interested in. We have deals coming in all the time. We have a gal whose job it is just to receive all the different opportunities that get thrown our way because everybody wants to promote themselves through us. We don't really endorse anything in particular. We're not in that business, but I liken it to like running a bar. If you run a bar, you create an environment where people can get together, but you're not really responsible for what they do. You just create an environment where they can meet each other and get to know each other. So if you go to realestateguysradio.com, under the resources tab, you'll see Investor Registry. If you click on that, it's very simple. You just fill out a form and a bunch of check boxes of things that you're interested in. You profile yourself. That goes into a little database. And then when deals come into our world, we have a gal who reviews them. And then as long as the people aren't known felons or bad people, we will ask them to fill the form out and check all the boxes. And when the boxes match up, we will send an email to you saying, hey, somebody brought us something that looks like it fits something you're interested in. We don't tell you about the deal. We introduce you to the person and then let you do your homework, your own due diligence, and decide whether or not you want to get to know them and do any business with them. That's 100% on you. So we just thought it was a great way because we get these questions all the time and we see the opportunities. We can't buy or do everything that comes our way. So we thought the best thing we could do is just open it up. But rather than deluge everybody, we would just let you pick and tell us what you're interested in. We'll only send you that.
Now, the plan is to have serious folks in there, so there's a price to get involved, but right now we're waiving that. So you can join for free. I think it's going to be $99 a year, so it's not cost prohibitive. It's just to keep the looky-loos out, if you will, because we don't want to waste your time and we don't want to waste their time. And it's not just for syndication. What Investor Registry does is put all kinds of deals in front of folks who are interested. That's why you want to spend some time on the profile and make sure you're only clicking the boxes that you'd be interested in. Don't just click all the boxes to see what comes through. We will tell you it's not very robust yet. There's not a deal every day. There's not even a deal every week, but it's definitely a focus of ours this year and in the coming years, so you can get signed up for that. Good question. Thanks, Graham. It's Ask the Guys. Your questions are answers today. When we come back, we're going to ask you a question for Real Estate Guys Trivia. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
When the world changes, investing strategy changes too. The coronavirus is disrupting economies, financial systems, and daily life like nothing in modern history. Sheltering in place might protect you from the virus, but a wait-and-see approach to investing now is like pulling the sheets over your head while the house burns down. It's not the time to be complacent. So we're calling our huge network of thought leaders, seasoned investors, and technical experts to find out what they're seeing, thinking, and doing to mitigate risk and capture opportunity, and we're recording all of it. We're calling it our Coronavirus Crisis Investing Webinar, and it's totally free. All you need to do is register. Remember, mainstream media doesn't talk to real estate investors. They don't understand you because Wall Street pays them not to. That's why the real estate guys are here. To register for the Crisis Investing webinar, simply send an email to crisis@realestateguysradio.com. That's crisis@realestateguysradio.com. Real world wisdom is the best vaccine for a healthy financial future. Send your email to crisis@realestateguysradio.com.
Hungry for more real estate investing ideas? Here's 2 steps you can take today. First, go to realestateguysradio.com and sign up for our weekly newsletter. You'll get access to a continuous feed of thought-provoking commentary specifically for real estate investors, while also focusing on broader picture economics. Then, once you're at our site, look for the Resources tab, where you'll find our amazing collection of special reports. Browse dozens of white papers, webinars, and market reports, and request the ones that appeal to you. What are you waiting for? Head to realestateguysradio.com to implement education for effective action.
Hi, this is Mauricio Raul, founder and CEO of Premier Law Group, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. We're so glad you've tuned in today for Ask the Guys. Such amazing questions from our awesome listeners. Before we get back to answering those questions, it's time to play Real Estate Trivia. That's where we give you a question, and we do this every week, have for more than 20 years. We're going to come up with a question that is something to do with real estate. When you hear the question, you're going to come up with the answer by sending an email to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Include your name, the answer to the question, and your mailing address, because if you're the winner, we're going to give you an awesome book by Robert Kiyosaki, maybe one you haven't read, called Second Chance. It's a great book and a really good time to be reading this, kind of a do-over. People are reinventing themselves. Good stuff. In fact, I just talked to Robert this morning. He called out of the blue just to say, hey, I'm just checking in on my friends, making sure everything's cool with you guys. And we talked for half an hour. It was awesome. So this is a really, really cool book. And last week on the show, before we give you this week's question, it was Clues in the News. We asked this: which U.S. state is the biggest provider of steel pipe and cast iron goods in the U.S.? Well, the answer is the great state of Alabama. Here's our real estate trivia question for this week. Where is the oldest wooden building on Earth? Now, if that's not a real estate question, I don't know what is. Somewhere on this planet of ours is the oldest wooden structure that still exists. Where is that? If you know or you just want to guess, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. We need your name, the answer to the question, and your mailing address. The first one that gets it right will get Second Chance by Robert Kiyosaki. That's today's real estate trivia question. Speaking of questions, this is one of our favorite shows to do. It's called Ask the Guys. Your questions are answers. This question comes from John in Helena, Montana. Hey guys, thank you for being awesome at creative solutions. Due to the recent events, I have a couple of laid off tenants who have done the right thing, reaching out that they will struggle making rent. Do you have any creative ideas that'll keep me from becoming the last bill paid? I'm a longtime listener. Thank you. By the way, I attended one of your seminars in roughly 2000 or 2001 and still have a copy of Equity Happens. By the way, it's not for sale. All right. Well, John, this is a great question. We talked a couple weeks ago about being proactive and really reaching out. Even last week, we talked about reaching out to your property managers now that we've passed the first of the month so that you're aware of what's happening. So I think creativity is part of the picture here. All tenants have decisions to make every day about where they put their money. And most tenants who are unemployed aren't sitting on months and months of savings. The average tenant probably has less than a few weeks of savings. So I'll share some ideas and we'll pass it over to Russ. We've had several buildings over the years, smaller multi-unit buildings that weren't big enough to necessitate a full-time property manager. But we always had a tenant there who was kind of our boots on the ground, eyes on the street. And what we typically did is said, hey, if you'll do some things like just pay attention and be available and maybe take the trash to the curb, we'll lower your rent by a couple $100. It's not free rent like an apartment manager might get, but we'll give you a discount. And that worked really, really well. So one of the ideas now is if you have someone who can't pay you in dollars, knowing that they're likely to have unemployment coming, or perhaps they're going to get some help from the stimulus, so they will be able to pay. What you don't want to do, I don't think, is forgive them of their rent. But what you could do is what a lot of the mortgage companies are doing is some sort of forbearance. Hey, let's cut your rent to a third for now, and you'll owe us that later. The difference, obviously, in a mortgage, they've got collateral and you don't against your tenant. but you might get creative in terms of having the tenant do something else that will help you instead of just money.
I think for sure you want to have an open dialogue, especially with people that were proactive and came to you with open dialogue. This is a great opportunity to build your brand, to build a reputation as being the kind of landlord that people want to rent from. A lot of people think price is the only thing that sells a rental unit, and maybe in some markets that's true, but I think that there are tenants that would actually shop for a great landlord. And if you get that reputation, that can end up with your retention, reducing your turnover expense because people will take better care of your property because they like you as a human being, not just as a landlord. And that's a financial return on your investment of kindness and generosity as well. So that's one part of the equation. I think the other part of the equation is figuring out the other side. You've got cash flow. You've got money coming in, which is your rents, or in this case, disruption of rents. But you also have your mortgage payments and taxes and other things. And I think being very aware of what your options are with your specific lender in terms of any relief you might get, what documentation you need to bring in that your rental income has been disrupted, having conversations with the other vendors and people that you have expenses with. Everybody is going through this. In many ways, it's uncharted territory, but I do think that there is an unprecedented level of community cooperation. I think the government is stepping in saying, hey, we're going to give you some relief from a tax basis, from a lending perspective. The lenders are coming in from an interest rate perspective, forbearance agreements. Everybody is very much in front of the disruptions in cash flow, which is very different from how 2008 was. So make sure you're talking to both sides, just like you appreciated your tenant being proactive. Be proactive with your lender and other people that you're going to need to pay. And if you can balance out your expenses, then I'd say don't take advantage of that to double dip. Go ahead and pass that along to your tenants and be a good citizen, because this is going to be tough on everybody. But I think in the long term, as I mentioned, that kindness will actually pay a long-term dividend in your reputation in the marketplace with retention, loyalty, and reduced turnover expense.
A couple of things that actually work in our favor right now. With people sequestering in place and not interacting as much, you don't have people couch surfing, because a lot of folks are very hesitant to allow their friends just to come in for a few days. So people have more reason than ever to stay in their apartments, to stay in their rental homes. And the other thing I want to bring up is that typically a contract you have, like a rental agreement, doesn't really have any long-term teeth in it. It is not secured by anything. So here's another idea. If you were going to be gentle and allow some forbearance, so you have a tenant paying $1,000 and they come to you and say, I lost my job. And you say, well, the last thing I want you to do is lose the roof over your head. Let's talk about what you could maybe afford for the short term. And you negotiate a rate. I would now have them write a note to you that they're promising to pay, because you didn't have that before. You just had a rental agreement that says if they don't pay, you kick them out. If they are incurring a debt and they quote unquote sign for that, maybe now you do have something that outlasts the tenancy. Not that you would necessarily want to go after it, but you could. Obviously, if you're going to take that idea, just talk to an attorney about it, because there's tenant and landlord law to consider, and there's just also tenants' rights. But great question. I think today is the time to be creative when it comes to this, and we do have to be more gentle as landlords. I remember back about 20 years ago, we had quite a few holdings in Northern California, apartment buildings, and rents were going crazy. It was a big boom, and there was just no vacancy, and landlords were able to ratchet their rents way up. And the local apartment association came out with an urgent warning saying, hey, landlords, just because you can raise the rent 30% doesn't mean you should. If we don't monitor this thing ourselves, then the government's going to come out and tie our hands to our back. It was a really interesting communication. And I think, to your point, Russ, this is the time to be a kinder, gentler, more understanding landlord, and we're all in this together. All right, let's ask the guys. Your questions, our answers. This question comes from Lynn in Yakima, Washington. Hey guys, I just binge listened to your last 24 podcasts and was super excited to hear them. I have 3 rentals that are completely paid for and valued at about $800,000. It seems like I could leverage this money and realize an 8 to 10% cash on cash return. And if so, my husband and I could retire. We're both age 60, but without enough assets to retire, in part due to medical tuition for 5 kids. All right, so we're not going to talk about that part of it, because we just went through at the beginning of the show, refinancing, pulling cash out, etc. But assuming, you're going to access that cash and put it to work. Now, she says, I contacted Mid-South home buyers, but they have a 9-month wait just for one home, so that's not very workable. Okay, that's a reality. We love Terry Kerr and his team at Mid-South, but they definitely have more demand than they have supply, so that's true. It may not be workable this minute. If you're interested in that kind of property, you got to get on the waiting list. I also had a consultation with another one of your providers, but it seems like their cash-on-cash return only comes to about 3%. So also not that workable. Do you have any other resources or contacts available? There must be more companies like Mid-South. Thanks so much for any assistance you can provide. Well, we actually had a question on the last Ask the Guys about our provider network, how we find folks. And we definitely have providers, and in the Real Estate Guys vernacular, those are real estate developers, turnkey operators, landlords, brokers, people that can help investors find property. But it's not an exact science. And what happens, of course, when the word gets out that someone's doing a great job like Mid-South, all of a sudden, everyone wants a property. And what Terry is firm on is he won't lower the quality or raise the price on an investment property just to be able to get more into the marketplace. So that's a good thing, but it's also a bad thing. But in reality, there's probably lots of folks who do have deals available. We talked about Investor Registry already, but I think a key to this is that certainly folks that the Real Estate Guys have, and you can check that out in our resources section of our website. But also a great thing to do is just to network with other investors. Where are they finding deals? Some investors just sniff out all their own stuff, but many investors like to find a company or companies they can work with to provide inventory.
There's no reason not to get on Terry's waiting list, by the way. I mean, 9 months from now, it's going to be 9 months from now. You might as well be on the list. Nothing says that you have to say yes when the property finally comes available, but at least you'll have the option. So I would definitely do that. And then the rest of it is really just a matter of being patient. We talked about this earlier, but if you've got gobs of equity and have access to it, I would tap into it, even if you have to park it someplace. If you can just get to break even and be liquid, I think that if you're patient, some deals will be coming to you because the market is changing right now. Be patient. I think the market's going to come to you if you're patient, but if you leave your equity in the property thinking it'll be there on demand, you're going to be on the wrong end of that equation.
Thanks for your question, and thanks for binge listening. It's a time for that. We got lots of shows, hundreds of shows in the archives if you got nothing else to do. This next question comes from Emma in Riverton, Utah. She says, guys, I just put 34 units under contract in Little Rock, Arkansas, and have been running into the "but there's high crime" argument from potential investors. I see you like the area for real estate, so was wondering how you respond to the crime issue. I'm excited about this project and seeing your positive review on the website, wondering why I'm getting so much pushback about the crime. All right. Well, first of all, every market's different, and I firmly believe that any investor can only really know a handful of markets. So we're only in a handful of markets. I first went to Little Rock about 20 years ago, and there was a lot to like then, and there's a lot to like now about that market. But certainly crime is one of the things that not only tenants look at, buyers look at, lenders look at, but also potential investors. If you're raising money to do a deal, they're going to take a look at that. But it's always compared to what?
So we had the same problem come up when we first started going to Memphis way back in the day. We went into the Memphis marketplace. Everybody told us high crime, high crime, high crime. And if you look at the stats, that was true. Now, when we got there, what we discovered was that it was isolated into certain pockets. And if you knew where those war zones were and stayed out of them, for the most part, you were fine. I don't know why it was. It was like there was this invisible barrier, but it seemed like all the crime kind of just happened in these areas. And our boots on the ground team knew right where those areas were. And that was one thing. By going and spending quite a bit of time in the marketplace, and we would drive around and we'd go into restaurants and shops and just go in and out of units, we were listening. We were looking for signs of crime. We were listening for sirens. We were trying to find out, is this a war zone or not? And it turned out not to be anywhere as bad as the stats. But the really big eye opener, and I'm not saying this is the case in Little Rock, but this is the point that I'm making, is it's important to dig down into the weeds and find out where those crime stats are really coming from. Because you don't buy an MSA, you don't buy a macro, a town, a big area, you buy a neighborhood. And in Memphis, they had a thing called Blue Crush. And this was the way that the Memphis Police Department increased and better tracked where the crime was so they could deploy resources more effectively. What it meant was they had to report every little thing. Instead of trying to pad their statistics to make their crime look low, they actually reported everything so their crime looked high, but they knew exactly where it was and they could respond to it better. In fact, they were actually trending down in their crime control because of the Blue Crush program, even though their crime stats went up. And when the police guy came out and told us about that, it blew us away. So again, I'm not saying that's what's happening in Little Rock. What I am saying is that don't just look on the internet or look at, what Zillow or somebody says what the crime rate is and they pull from some statistic. Talk to your property managers, get down in the weeds and find out exactly what crime looks like in the very neighborhood that you're investing in and what the trends are. And you can probably find pockets of opportunity. At the end of the day, people are going to live there. And as long as the rent's getting paid and the crime isn't affecting you directly, then in some ways it doesn't matter what the crime is in the bigger picture. It's like Oakland, California. Because crime in Oakland is really bad. Yeah, but you know what? I mean, notwithstanding rent control and California landlord tenant and all that, but if you just look at Oakland as a high crime area, there's still very desirable areas and properties even in Oakland. So that's true all across this country. I'm sure it's true in Little Rock as well.
You make a great point, Russ, which is every area has the tougher parts of town, no matter where you go. I remember when we had a specific situation, we were doing a syndication project and our syndication attorney was actually interested in putting some money in. And he said, guys, I was just looking and the crime is so high there. So Russ did a very clever Russ thing. He researched the crime where this high-end attorney lived and discovered it was 1 point higher on the crime index than the deal we were looking at. So that's a really hard thing to argue with when where you live is literally a higher crime district. I'm just looking at a list of the top 37 crime areas, MSAs in the U.S. And there's great markets here that there's tons of crime in, but not every neighborhood. So I would say if you're having trouble with investors, it's all about educating them and you can't make them wrong. If they just look and say, there's high crime, you have to have some ammunition for that discussion. So get into the marketplace, talk to the police department, find out those sides of the line, and then make sure your property, one, isn't in a high crime area, and two, that you know how to communicate that. I will say that there are properties that can be successfully managed in high crime areas. That takes a very special, particular management company, but it can be done. So high crime is an objection, but it's probably one you can overcome. It's Ask the Guys. Your questions, our answers. More questions when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
When it comes to successful rental property investing, it pays to be picky. Pick the right markets, pick profitable properties, and pick great property management. That's easier said than done, but we've got great news. Terry Kerr and his rockstar team at Mid-South Homebuyers are going strong in Memphis, Tennessee, and Little Rock, Arkansas, too. So for a top-notch turnkey single-family home rental property, whether you're a new investor or have a large portfolio already, pick Terry Kerr and Mid-South for a truly A-plus investing experience. To learn more, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
Hey, this is Gene from the Residential Assisted Living Academy. Making money, cash flow is important. Doing it for the right reasons with a heart is even more important. If you'd like to learn more about turning a single-family home into a cash flow machine, earning $5,000, $10,000, $15,000 net or more per month, well, I'd like to share that with you. Our motto is do good and do well. There is a silver tsunami of seniors coming, and you have a huge opportunity. Take advantage of it.
To gain access to an informational webinar presented by certified financial planner and real estate entrepreneur Gene Garino, and discover how you can turn a nice home in a nice neighborhood into a cash flow machine, send an email to ALF, ALF @realestateguysradio.com. That's ALF @realestateguysradio.com.
Hi, this is Darren Hardy, author of The Compound Effect, and you're listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program, now in our 23rd year of broadcasting. Hey, we've got this great coronavirus crisis webinar we're putting together. Some amazing folks are going to share on this thing. If you'd like to be invited, there's no cost. Just send an email to crisis@realestateguysradio.com. We want to all be together in terms of getting different perspectives and figuring out how to get through this thing. It's crisis at realestateguysradio.com. Today's Ask the Guys. Your questions are answers. Our last question today comes from Ruben in Vermont. Hey guys, my business partner and I just attended the Secrets of Successful Syndication and are beginning a syndication company. One of the biggest questions that we do not have answers to is what happens when a limited partner wants to exit a syndication deal? Is there a buyout option, refinance options, or are they committing to the term that is presented in the particular syndication project? Thanks, Ruben. Well, we talked earlier about passively investing in a syndication, and you can think of those folks as limited partners. And we call the person that organizes the syndication the sponsor, or the promoter, or the syndicator, or the primary partner. Lots of ways to talk about that person. But limited partners are typically going to invest in the duration of the deal. And it's one of the downfalls of syndication, but it actually can turn out to be a strength. And that is that unlike the stock market, you can't just easily sell in and sell out of your position. So a couple of things. When you present this deal, you want to make sure that you completely explain the intended duration of the deal. And I say intended because things can change. You can say, hey, our plan is we're going to buy this building, we're going to hang on for 5 years, then we're going to sell it at a profit. Well, if that was your plan last month, before there was a coronavirus really rearing its head like it is now, and you got that deal put together, who knows? Your whole timeline could be completely off base now. So part of it is understanding that. And the other is there are ways to be able to take care of people that have situations. So having been in the syndication business a long time on the front end, as the syndicator, we always make sure that our investors understand there is no liquidity. If you have a need, if you need your money back, you can't get it. That's as plain as day. You cannot get it. Having said that, over the years, we've had situations where an investor would come to us and say, hey guys, I know this is not liquid, but I just really, really need the money. Most of the syndication documents will call for something to happen in that kind of a situation. Typically what it says is the limited partner can offer their shares or their membership interest to the other partners or members on some sort of basis. Sometimes you as the syndicator get first right of refusal. I'd be careful about that, but it is possible. And we've had a couple of cases, I will say, over the years where we did find a way to get somebody out. But that's the exception and not the rule.
Yeah, I think that, first of all, we're not lawyers, so you should always check with your securities attorney when you're drafting the documents to be sure that you put things in that are compliant and also reflect the level of flexibility that you want to provide to your investors. Robert's point is well taken. You set the expectation up front. The reason this is a stable investment is because there is no secondary market. It can't be used as a gambling chip in the market. It doesn't get traded around like things that get traded around. But what it is it's a commitment to do a deal and see it through. With that said, you have these options. The thing is, you have to make sure if you're going to offer it to anybody that it's offered on an equal basis. You can't give somebody preference. You can't give yourself preference. Now, you may get first right of refusal, and everybody knows that going in. Again, check with your securities attorney. The main thing to realize is it's not just a matter of making sure that you can have the money and finish the project, but it's also to make sure that you and the other investors don't end up with an unvetted partner. If you got a limited partner and that guy just one day wakes up and says, I don't want to do this and we're going to sell it to my neighbor, and the neighbor is not a very good guy to do business with, but you're stuck with him because that's who he sold his share with, you don't want to have that. So when you're telling the people on the front end these provisions that are in your agreement, they're there to protect them from other people in the deal, bringing in other people in the deal. So there's a lot of reasons why these deals are structured the way they are, but it does take a little education on the front end for someone who's investing passively through a private placement for the very first time to make sure that they understand this is not like buying a mutual fund or buying a stock in terms of having a secondary market. There is no secondary market. You're very restricted on getting in and out of these deals.
Thanks for all the great questions today. We'll do another episode of Ask the Guys because we got a whole bunch more questions to get to. But that doesn't mean we don't have room for yours. If you have a question for the Real Estate Guys, just go to realestateguysradio.com, click the button that says Ask the Guys. Lots of really great shows coming up. We're going to do our best to shepherd you as we shelter in place through all the crazy things that are happening. And next week, we've got an extraordinary guest. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.